Hello and welcome. Today we will look at the stock of Alibaba and why it is very attractive to buy at these prices. Okay, for those of you who do not know, Alibaba is one of the biggest companies in the world. It's an e-commerce company based in China, and its business model is is centered around exporting Chinese goods to the rest of the world. Okay, now the stock price has been depressed lately due to the Chinese government's crackdown on Chinese tech companies. This is due to power struggles between the Chinese government and the biggest Chinese companies. Well, this does not mean that the company is not good. The company is still very, very good. Actually, it's an excellent company. And if you are an investor for the long term who are willing to stomach those little volatilities in the short term, this is an excellent opportunity to buy this company at a very cheap price. Okay, now let's look at the financial reports of the company. First of all, let's look at the financial statements annually. According to the financial statements, we can see that the company's revenues has been growing uh, pretty consistently over the last decade, okay, which indicates the strength of the company, as well as the company's earnings per share. It also has been increasing consistently over the last decade or so. Okay, this indicates the company is managed very well and it has a very good management. This is one plus. The second plus is that the company has a very strong balance sheet. What does that mean? That means that the debt and liabilities ratio compared to the assets is very low. That's compared to other companies in this sphere. For example, it has to, as of 30th of December 2020, it has total liabilities of 86 billion, okay, compared to a total assets of 250 billion, which is only 34% of this company's balance sheet is sourced from debt, which is a very good metric. 34% is very low. It means that the company has very low debt. Okay, this is important. Why? Because it indicates that the company is at low risk of bankruptcy. If I had to bet on a company, put my entire portfolio in one company, this is one of the leading company I would put my entire money in and go to sleep like a baby. And we can see also that the company has a positive cash flow. Let's look at it annually. Pretty consistent positive cash flow, which is also very important. Net cash flow, let's look at it. It's positive and consistent over the last decade. And besides that, let's look at the chart of the stock price. We can see that the peak of the stock was around October of 2020. The stock price was $306. Since then, it has been declining in a consistent rate, and we can see that there is a strong resistant line that every time that the stock touched this line, the stock went down. Okay, currently we are very close to this resistance line, and if it breaks above 225 approximately in the next few weeks, it means that it broke this line and it will go much, much higher. We have also seen in the last few weeks that the $200 price was a very strong support for the stock. Each time it touched it, it bounced back up. Currently, the company is trading at about 25 PE, which is very attractive for a company like this who is growing very fast. And if you buy this company, I would recommend buying it in stages, meaning you can buy a portion of your portfolio now, meaning you need to make to to divide your portfolio into approximately 10 portions or 20 portions and buy only one portion now. And if the stock price continues to go down, you buy another portion, another portion, another portion. If the stock starts to go up from this support levels, you can also add to the stock price as it goes up, but be careful. Generally, I only buy if the stock price goes down. And that's it for today. Thank you for listening. See you on the next video.